Hey guys, welcome back to the channel. So I wanted to do a bit of a video today on a mindset shift that I've had in my own investment journey, which has really transformed the way that I think about property. And a lot of investors, they invest in property and they think that the goal is to acquire as many properties as quickly as possible. But what they don't talk about is the reality that comes along with that, the constant tenant issues, vacancy periods, rental arrears, unexpected maintenance costs. There's a host of issues that you inherit when you become a property owner, and these amplify with the more properties that you own. Now, personally, I'd rather focus on earning assets that actually work for me rather than against me. And in this video, I want to try explain to you why chasing more for the sake of it is actually just a trap. Guys, my name's Josh. I'm from DataEdge Property. I help everyday Australians grow their wealth in the Australian property market using data that's accessible to absolutely everybody and which you could start using today. So with that being said, let's jump straight into the video. So the first thing I wanted to touch on and the first theme I wanted to discuss was the common investor trap of collecting properties. What do I mean by that? So many investors, they think that success equates to building the biggest portfolio possible. And when I say the biggest, I mean with the highest quantity or number of properties. But what they don't realize is that each extra property adds complexity and risk. And it's not just about the everyday costs that each incremental property adds, such as what I mentioned earlier, but even just entering or investing into a particular property, it takes up a lot of resources. You got to spend time researching a suburb, researching a particular asset type, researching the yield, researching a host of data factors just to enter into that suburb. And it becomes time, but also cost prohibitive to be doing that on a massive scale. And when I say massive scale, again, I'm talking about the number of properties, not the dollar value. So the reality is more doors means more tenants, more maintenance, more admin, right? And when I say more admin, again, it's those entry costs. They amplify with each property. You got to spend on a building and pest inspection. That's going to set you back anywhere between $500 and $800, right? And you got to pay that for each time you try to buy a property, which you might not be even successful for, but you got to incur that cost. And the example of how this then impacts your life is that rather than being able to enjoy the wealth, which is the whole reason we even invest in property in the first place, investors are going to spend weekends on other stuff, non-value add items, dealing with issues that hold them back rather than propel them forward. So that's the first theme that I wanted to touch on. The second theme is that weak assets, they create hidden problems. What do I mean by that? When you prioritize the number of assets that you acquire, you all of a sudden start ignoring important data factors, such as the yield. And investors that don't prioritize yield end up investing into a cash flow drain. Properties that look cheap but don't actually perform over the long term. They cost an investor money each month simply because they were chasing the wrong thing. Constant maintenance costs. Again, if you're just purely trying to get into the next property as quickly as possible whilst ignoring other important data factors, you might overlook the fact that a property has environmental issues or has maintenance issues heading into it because let's say you just didn't have time to do a building and pest inspection. You were just too quick to chase a underperforming asset. You might incur tenant headaches because the area that you've invested in, which you didn't do the right due diligence on, is a high crime area, or it's got a high likelihood of having tenant issues. And by investing there, you're going to be dealing with other issues such as late rent or constant turnover or stress going to tribunals like VCAT or equivalent tribunals in other states. Again, these problems, they compound when you own multiple underperforming properties. And if you're prioritizing the wrong thing, such as the number of properties as opposed to the quality of the properties you own, you can easily fall into this trap. Now, the third theme that I wanted to touch on was that strong numbers do the heavy lifting. And I mean strong numbers on an individual property basis, not strong numbers in terms of the number of properties. If you invest into a market prioritizing the right things, like having a strong yield, for example, you're going to be able to enter a market and cover the costs. Not just cover the costs, but you're going to build cash buffers over time, which is going to allow you to hold on to properties for the very long term. And we know as investors in the Australian market, irrespective of the market that you invest in, over the very long term, you're going to get that 6.5% capital growth over the long term. And when I say long term, I mean 20, 30-year horizons. If you instead prioritize the wrong things or just even ignored those important data factors, and let's say you invested into a suburb that had a bad yield or an asset type that had high vacancy rates, then you're not going to be able to hold on to that asset. And what that will mean over the long term is you're not going to reap the rewards of compounding. So the other thing is, if you ignore growth drivers like population growth, infrastructure, supply levels, those are the things that add long-term value and short-term value. If you're not prioritizing those, there's a high likelihood that you're not going to get the capital growth results that you want in the short and medium term. That assumes that you can actually hold on to the property, which assumes that you got in at an adequate yield in the first place, which if you're not prioritizing those factors and instead you're just prioritizing getting as many properties as quickly as possible, it'll likely slow you down, not speed you up. And the best example of that is, let's say you quickly, without any thorough research, just invested into a property, or perhaps even worse, listen to a buyer's agent that, had a hidden agenda to send you into an area that had poor data metrics. Well, you might end up juggling three poor tenants that have cash flow issues, that damage your property, that attract crime to that property, as opposed to if you had invested into one really strong asset with great prospects in a great area, and you would have just been dealing with one tenant that actually pays you on time. Let's say like a family with kids that, go to schools in the area and that you're going to have much less issues with. So again, the key there is that strong numbers, they do the heavy lifting, right? It's not the number of properties that you own. Now, the fourth theme that I wanted to touch on was that you'll actually be able to scale your portfolio better and attain greater leverage and greater borrowing capacity by having higher quality properties in your portfolio. Banks, they look at portfolio strength. And believe me, I've worked in corporate banking for the better half of the last 7 years. We don't care how many properties you have, right? You could have 30 properties or 40 properties. It's the quality of those properties. It's the dollar value that they add to our security or to the bank's security. The bank will always prefer to have higher quality assets on its balance sheet rather than lower quality assets on its balance sheet. So strong assets, they also improve serviceability. So if you've entered into an area that has a really high yield and it helps to service the loan, that's going to help you much better than if you were to have invested into an area that has a 2% yield, but okay capital growth prospects, because all of that feeds into serviceability. Again, you'll be able to access better leverage and borrowing capacity if you prioritize fewer high quality properties as opposed to a greater number of low quality properties. And at the end of the day, a few profitable properties open doors to bigger opportunities. It'll allow you to scale your portfolio quicker and enter into higher performing properties in the future. And the best example of that is that a high yield, low vacancy asset supports your next deal much better than 3 weak apartments will that have, let's say, a really poor yield and poor growth prospects. So again, something to keep in mind, all of this can actually influence in a big way your borrowing capacity. And the most successful investors, they understand that to scale a portfolio, you need to have strong assets in your portfolio. It's not just about attaining 30 properties, which, shouldn't be your goal in the first place. Now, the last theme that I wanted to discuss was that the long game is about freedom. It's not about stress, right? Property, the goal should be to give you more choices in life, not constant problem. And when you have fewer but much stronger assets, it actually helps you scale easier because you're not focusing on things that bog you down, right? You're not focusing on going to VCAT, or you're not focusing on vacancy periods or maintenance costs. You're focusing on the right things, and the right things are, redevelopments or renovations or, all of these things that'll free you up to actually do value add things. Maybe it's building a granny flat on your property. If you own the wrong assets, firstly, you might not even be able to do those things in the first place because you prioritized other things. But even if you can do those things, you're probably going to be too busy. You're not going to have the capacity to deal into those high value ticket items. So if you prioritize the right things, you're going to spend less time firefighting and more time growing your wealth. And these are the things that you need to be keeping in mind when you are entering the property market in Australia. And more importantly, you're formulating your long-term strategies. So guys, I hope you got a bit of value out of that video. And if you did, I'd really appreciate if you left a like on it. If you're interested, I've also got a completely free asset property due diligence checklist. Now, I review this every single time before I buy a property. There's about 40 dot points in there of the key red flags, risks, things to look out for. It's entirely free. It's a comprehensive list. If you're interested, it's in the link in the description down below. If you're interested, give it a download, and I'll see you in the next video.